Well, hey there, everyone. Happy Friday. Happy May. Welcome to Chart This with Dave Keller. It's Friday, May 1st. We are coming to you live on Facebook, LinkedIn, YouTube, and X. And I appreciate you, those of you joining me here on the live stream. We're answering your questions from this week. It's a mailbag episode. You are more than welcome to ask questions during today's episode. We probably won't have time to answer a ton of questions because I've already got 6 queued up that are pretty good that I've hand selected. However, we are always looking for more questions for the mailbags. If it's not something we get to this week, maybe we can share it on the show next week. April finished, we finished the month of April on Thursday's session with great fanfare as the S&P closed above 7,200 for the first time. I would not say May has started out in a dramatically positive fashion. The S&P did make a new all-time high today. Did make a new all-time closing high. Candle fans rejoice. There will be a candle quiz a little bit later. It's not too hard a one, and the S&P 500 chart features one today, and it's not a great sign going into the weekend. Having said it, the most bullish thing the market can do is go up. That's something I was taught earlier in my career, and I stand by that. S&P keeps making new highs. That's a reason to be bullish. With that in mind, let's talk about market conditions here today. We'll do a quick check-in on the markets. On Friday, we do a bit of an abbreviated recap because I have a weekly flight plan over the weekend that I publish for all my market misbehavior premium members, where we really take stock from what happened during the week. We look back at what happened. What did we learn? What was new? What was different? We look forward to the week to come. What levels, patterns, signals are we watching for? So if you want a deeper analysis of the week and a good reflection on what the most important market moving moments could be in the week to come, you want to be a premium member. Marketmisbehavior.com/premium is where you can find more info on our premium memberships. I'd love to have some of you join this weekend for sure. With that in mind, quick check-in on the markets. The S&P closing at 7230. That's up just under 1/3%. It was up above, I'm almost around 7270 in the first hour of trading. Then kind of a nice, gentle easing off through the course of the day today. The NASDAQ did better and actually held those early gains and locked in about a 0.9% advance. Small caps ended up slightly higher. I was just doing the monthly chart review earlier today for my premium members and reflected on the fact that small caps are the top performing group, top performing major U.S. index year to date. Russell 2000 outperforming the S&P, the NASDAQ, the Dow, pretty much everything else. So small over large has been the general story, even though it's felt like large cap growth has been, dominant. Really hasn't been year to date. It's been, at times there have been pockets where they've done better, but small caps have outperformed large caps year to date. That's kind of the story. VIX, popped a little bit, but not much. I'm kind of chopped around 17, which is still a low volatility environment. Rates came off a little bit as bonds rallied slightly. This is a bit of a change, right? Once the Fed meeting earlier this week, and it became clear that market not pricing in a lot of rate cuts anytime soon. Rates started to push higher. So for the week, we saw a general uptick in rates, but down a little bit here today as the TLT was up about 1/3%. Dollar popping a little bit higher as well. And that's, again, so if you think about what happened out of the open, stocks opened higher, but then drifted lower, right, on the S&P. The dollar opened lower, but then drifted higher through the course of the day. So sort of an initial kind of risk on open, and then kind of lightening up a little bit more risk-off movement through the course of the trading day today. All right, looking at the commodity space, the DBC down about 1% for the day. That's driven by energy prices as it looks, sort of the headlines out of the Middle East appear to be implying, we're getting close to something, or they're talking about a ceasefire, or some broader, cessation of hostilities. Still haven't got to the finish line, but we're hearing that the finish line is near. As a result, crude oil prices are coming down. That's good. Good for consumers, good generally, because higher crude oil prices for longer are not generally helpful. Gold basically flat for the day. That's after spiking way higher at the open, kind of drifted lower through the course of the day. Silver did as well, but silver, similar to the NASDAQ, one of the bigger winners today through the course of the session. Cryptocurrencies generally higher today, but rolling over during the equity session. Bitcoin got almost to 79,000 earlier today, currently sitting just below 78,000. Sector-wise, it was only the FANG sectors that were positive today, right? So that's something that's worth noting, right? Technology, the XLK, up 1.5%. Then you got a big jump down to consumer discretionary and communication services, both up less than 0.25%. Everything else was down. Energy, the biggest loser today. Certainly weaker crude oil prices. That's the story there. Industrials down almost 1%. Utilities down about 0.2%. This wasn't a great day in terms of sector breadth. It was kind of the three growth sectors, the NASDAQ doing well, everything else kind of, weakening. And through the course of the day, it was sort of like more sectors going from green to red, which is kind of interesting. Breadth literally all over the place. So we'll make sense of it the best we can here. But basically the breadth of the New York Stock Exchange, which is the top line, neutral, if, tilting slightly negative, 46% up to 51% down. On the NASDAQ, the breadth was fairly positive, 59% up to 38% down. In the S&P, the breadth was kind of the opposite, only 35% up to 65% down. So the breadth in the S&P was bearish. The breadth in the NASDAQ generally bullish. The breadth in the New York Stock Exchange, essentially neutral. That was the story today. So depending on what area of the market you looked at, this is sort of an interesting day here. All right, quiz time. And I'm guessing, I didn't have the comments up, but I'm guessing someone picked up on the obvious candle pattern, the shooting star candle. I saw someone popped it on there. Larry, no surprise. You always you do not disappoint dropping candle patterns when prompted to do so. Yeah, that's what that means, right? So today, earlier in the day, it looked like we were going to accelerate, maybe close above 7,300 for the first time today. That's after yesterday's first close above 7,200. So started to feel like a pretty strong move to the day. I mean, so if there's one takeaway, it's like we just couldn't get a win here at the end of the week to just feel really good about life over the weekend. I love these little asterisks, great week, except, oops, shooting star candle. It's kind of short-term bearish. No, again, remember, candle patterns are not meant to be and not designed to be major reversal point kind of indicators. They're really designed to only tell you about the next 1 to 3 bars. So on a daily chart, that's basically saying Monday through Wednesday, most likely weaker rather than stronger, given the fact that we have a shooting star candle on today's session, which basically is a reverse, a short-term reversal sign, saying there's a lot of optimism going into that candle. That candle represents indecision and distribution through the day, implies that we probably are weaker at the beginning of next week. Now, again, a lot can happen headline-wise. That is the setup as of this moment. We'll see if there is a further catalyst to happen between now and then. All right. That's all the market recap. Again, for our premium members, we'll have a much deeper dive into some weekly takeaways and starting to look forward to next week. We'll get that out to you over the weekend. Again, go to marketmisbehavior.com/premium if you want to be part of that fantastic group of mindful investors that we are mentoring as a group. All right, let's get on to some of these great questions. Again, these questions came from all of you over the last week or so. Some of these questions came during our live stream, and I pull those out at the end of the episodes. Some of them you were watching our YouTube channel and dropped a comment there with some questions. We grabbed them there as well. Let's get to the first question. What is the time limit for a bear market rally to occur given today's charts? This move to all-time highs just doesn't seem justifiable to me. Yeah, so really, really good question. And if you followed my work, and again, I mean, I have the blessing, but also the challenge of the fact that I have a daily market recap show. So it's hard for me to hide kind of what my take is on the markets, right? And so many of us have the benefit after something happens, there's this thing called hindsight bias, where your ability to call major turns actually gets better and better in your brain as time goes on. So if you look back at like the COVID top or the 2025 peak, your brain will tell you, or even just more recently in like February of this year, as time goes on, you optimize your own memory of your performance. It's called hindsight bias. Like our track record gets better. So I guess this is a natural tendency. Obviously, it is to make ourselves feel better about what's happened in our lives up until this moment. The problem is it can be very misleading. I mean, hindsight bias is fine. The problem I have is I have daily time-stamped records on my YouTube channel of exactly what I've said at any given moment. So I'm very open about when I am pretty right on things. And there were times when I felt very good. There are times when I'm on the wrong side of things and I have to adjust. And again, People love to call out like, well, you were bearish, what happened? Or, oh, you were bullish, what happened? What happened is the market changed, right? And that if you're saying something like that, I guess you're probably not watching the show enough, because we try to keep reinforcing this is not about predicting the future. I have been wrong plenty. I'm going to be wrong again. All of you are wrong a lot too, and probably will be wrong a lot too. It's not about being right all the time, right? That's not the measure of success. It's when you're right to stay right as long as possible. When you're wrong, to admit you're wrong as quickly as possible. That adaptation, that ability to adapt to changing character in the market, I think that's the game. And I think people, too often celebrate people that, got the call right, pinpointed a turn, as if that's really the goal, right? Our goal should not to be right all the time, because if someone says they are, they're lying to you or lying to themselves, or both. No one's right all the time, and most people are not right nearly as much as they think they have been. The challenge, and I think the number one goal for investors, is to adapt, is to adjust, and to recognize when conditions shift. And that's why we've built our process around trend following and our market trend model, and just ways of defining trends and changes in those trends. So I was very bearish at the end of March. I will say that openly. And if you go back, we were talking about downside objectives beyond. I remember talking about 6,200 as an objective, which we never reached. But what happened was, after that, and this is a long-winded answer to your question, which I thought was a great one. I remember at the beginning of April feeling like, and this absolutely felt like a counter trend rally. And I just interviewed Tom Boley for the podcast. That episode is not out yet. Hopefully tomorrow morning it'll be out too. Keep an eye on our YouTube channel and on the podcasting platforms. But Tom and I talked specifically about this moment right here, where the S&P is rallying. And his point was like, this completely felt like a counter trend rally. I mean, it just absolutely did. It felt like a downtrend, and it felt like a quick mean reversion move back to the upside, rallying right up to the 200-day moving average. Such an obvious rollover. And then we gapped above the 200-day. And I would say on that gap above the 200-day, my way of thinking of the market as an obvious bear market rally to something that might be very, very different, that gap above the 200-day was it for me. And that's why I think of kind of lines in the sand, or like what signal would tell you that a super bearish thesis is no longer appropriate. For me, getting back above the 200-day and holding it, that's pretty meaningful. So if you ignored that, the continued appreciation after that gap, I think, was such a great tell that this was part of an accumulation phase and not a, sort of selling the rips kind of phase. This was, steady accumulation. And we saw that with the volatility rotating lower, with spreads coming in, all those risk measures start to get better and better and implying further upside. We're seeing volatility come down as accumulation is happening. So I think there were plenty of signals along this way telling you this was no longer a bear market rally, and now something more significant. And now, once we get to new all-time highs, I don't think, to your question, you can't call it a bear market rally if we're making new highs. It has to be some other label. It has to be like a blow off top or something. Like there's something different going on here. Bear market rally to me means the primary trend is down, and it's this quick counter trend rally, within a cyclical bear market. I think once we get back above the 200-day, for me, that was the moment where, okay, this is something different. And then the movement after that gap, I think, was the most important than all the other things we track, right? In terms of volatility and spreads, those kind of things for me kind of help paint the picture. Yeah, there we go. Next, I'm sort of looking at the questions and and comments. All right, question number 2. Can you review how to use the Ichimoku Cloud indicator to predict where a stock may be heading, or how it offers ranges a share price might follow? Yeah, I love the Ichimoku Cloud charting. I get random questions on this, and happy to take a look at it. Just so you know, as I'm finding the chart here, 'cause this is one that I don't look at a ton, but I like to look at it sometimes. All right, so this is actually part of it. I'm going to show you this. So by the way, on stock charts, this indicator is called the Ichimoku Cloud. That's the Japanese name for this particular methodology. This is a Japanese form of technical analysis. And honestly, I've never used it as my primary technique, but I have, interviewed a number of Japanese technical analyst. I've traveled to Tokyo a number of times and have also in a lot of the banks, the Japanese banks in New York, which I used to call on pretty regularly. A number of people there use candle charts and Ichimoku Clouds, kind of the classic Japanese charting techniques. And again, in Japan, some of these are way more popular than the Western techniques that many of us kind of follow, primarily like RSI and MACD. Those just aren't as popular. The Ichimoku Cloud system, from my experience working with all of them, is it is designed to kind of be a complete charting system. It's part trend following, it's part projection, kind of thinking about forward-looking levels, and kind of also support and resistance is all kind of mixed into one indicator. On stock charts, they actually break it out into Ichimoku Cloud, which just has one of the three kind of main parts of the indicator, and then Ichimoku Cloud Full includes the full thing. On other charting platforms, they might call it something different. It might be like the Ichimoku Cloud, and then you have to like take off some of the indicators if it's too busy. So this is what the cloud chart looks like. And you can see it's kind of a spaghetti thing. I mean, there's a lot going on here. But just to, if you can kind of go through the spaghetti, and we'll kind of maybe look at this period, kind of a nice uptrend, easier to kind of get through. So the Ichimoku system has three components. The easiest one is called the lagging span, and there are Japanese names that I'm not going to try to butcher for you. So the anglicized version, there's the lagging span, which is literally the current closing price plotted 26 days in the past. So if you think about having like a price and it's kind of fluctuating, and if you look at the same price 26 days back, if you just kind of follow those, the price will cross up and down through that lagging span, and that basically gives you the change. And honestly, what happens is, so here, right, we can see that Apple was going lower, and the lagging span in green is going lower too, because it's the current price plotted 26 days back. When the lagging span starts breaking above the price, that's the bullish signal, because that means the price is going higher and it's kind of breaking above there. So the lagging span is above the price, that's bullish, because that means we're going up. If the lagging span is below the price, that means we're bearish, because we're actually in a downtrend. And so we look at where the price is relative to that lagging span. That is one piece of it. The second piece is the green and the red cloud, which is plotted 26 days in the future. This is actually one of the few technical indicators that's actually plotted in the future, so about a month out. And so it has a couple different indicators that are created. These are the leading spans that are calculated, and it basically uses a combination of open, high, low, close data for the last couple of weeks to project some different levels forward. And those forward-looking spans create this cloud. And so anytime someone talks about the Ichimoku Cloud, they're talking about that piece of the complete Ichimoku system. And that's the most commonly used, like here in the US. And some technical analysts like, Katie Stockton of Fairlead Strategies, who's on CNBC a ton, she uses the cloud system as part of her, kind of her core methodology, I would say. Then you have these two other, which are called the conversion line and the baseline. And these are here in blue and red. So, and so basically that's kind of like a MACD. When the conversion line crosses up through the red baseline, that's bullish. When the conversion line in blue crosses down through the red baseline, that's bearish. So it combines the lagging span, the cloud, and the conversion line and baseline crossover technique. So the idea, and the people that use this as a system, it's a complete picture. So you look at a chart and say, where are we relative to the lagging span? Here, the lagging span's above the price. It crossed over here, so that's bullish. Where is the price relative to the cloud? Well, we broke through the cloud back here in April, which was pretty bullish. And again, remember, we had that plotted 26 days in the future. So back here at the March low, you knew, all right, if we rally, and this is Apple we're looking at, if we get above the cloud, that's a bullish breakout. And so that is a bullish sign. And then the conversion line crossed up through the baseline there in April as well. So all three of those went from bearish to bullish, kind of late March to early April. Does that make sense? Now, in reality, though, I mean, that's just really busy. And most people are using the cloud methodology with other things. So like stock charts and a lot of platforms allow you to just show the cloud. And it's just using one of the three kind of main components. And here, quite simply, you think of the cloud as an area of support and resistance. So you think of it as a range, not as a level, but as a range. When we break through the cloud, that tells you there's a change in trend. So here where we're above the cloud, that's bullish, 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 bullish. Here when we break below the cloud, that tells you that bullish trend is now over and we're in some sort of different phase. Most recently, we broke above the cloud in April, and that's bullish here. And again, the idea is it's looking forward. So depending on how quickly we would sell off, if we do sell off from here, support could be down here around 260, or it could be up here around 270, 275, right? Because the how quickly we go off or drop would tell us how quickly we reach that cloud range. So that's a 5 to 7 minute briefing on the Ichimoku system. It's pretty complex. Maybe I'll do a deeper, video going through some of the nuances of everything I just said, but that's kind of how I do it. That complete system that I showed you, that full system it's called on stock charts. Very few technical analysts that I know of or traders in the US, besides those at like the Japanese bank, like the Japanese traders that are in the US, very few use that complete system. But if you go to Japan, you'll find a lot of people that are, believers in all of that. And then there's a whole methodology that they've developed to use those signals and compare them and everything. All right. Next question. What are the top 3 indicators you would recommend to determine when to lighten up a position or even get out altogether? And I mean, great question given what's happening in the world right now, because you've got a lot of charts just continuing to go onward and ever upward, as we like to say. So what are the 3 indicators that I would use, top 3 indicators to determine when to lighten up on a position? So let's say you own like a Western Digital, and I don't own this directly, but I own ETFs, I'm sure, that have exposure to the storage stocks. So what would I look at? So number one to remember is, as a trend follower, goal number 1 is to find the trend. And these names, Western Digital and Seagate, STX, both in long-term uptrends, primary uptrends, both have recently broken out to new highs. I see these are excellent charts. Some of the better examples I could come up with of just strong uptrend charts. So what are the 3 things I would look at? Number 1 would be moving averages. So for me, the 21-day exponential moving average is usually my kind of initial level of support. And the reason why I like that, it gets triggered often in a choppier market. But again, the benefit is not when it triggers. I think for me, the benefit is when it doesn't trigger. Like in this kind of move, like if we're nowhere near the 21-day EMA, like why are we even talking about the stock? The chart's great because if it's still above the 21-day EMA, that means it's just going up. It's going up because if it stalls or if it goes down, it's going to hit the 21-day EMA very, very quickly. So that's a great initial gut check. And so scan through your portfolio, which stocks are below the 21-day EMA. You want to know where you have some potential problems in your portfolio. That's a great starting point, right? Start with that list. And again, some of them you might be fine with, but at least those are the things that are just not currently actively going up. And so the 21-day EMA is kind of an initial thing. The 50-day moving average would be my second one. And this has helped me a great deal on charts like this because I look for a close below the 50-day and then another little move lower. So you had a couple times where you tested the 50-day and then bounced right back. And I think that's always a really good sign during a long-term uptrend. Those pullbacks are going to happen, but as long as dip buyers keep coming in. And so using moving averages in that combination, most helpful for me. Second thing I would use, and this is something I bring out like during an active position, and I really just want to make sure I have a good stop in mind, would be the chandelier exit system. This, and let me just get rid of these other things so you can see it a little better, right? So this is called the chandelier exit system. If you want more info on this, read Dr. Alexander Elder's books. I think the one is called Come Into My Trading Room or The New Trading for a Living. One or both of those books mentions the chandelier exit system. And I apologize that I don't remember which one. I should know that. But it's in one of those books of his that I read. And the chandelier exit system is a trailing stop indicator that uses average true range, or ATR. That is a brilliant way of thinking about a trailing stop, because if you think about like a biotech company, right, which is naturally kind of volatile, or like a cryptocurrency, which is pretty choppy in the short term, versus like a utility, which is, or a REIT, which is like very low volatility, not big percentage swings. If you use like an 8% stop or a 5% stop, the one, like a very volatile stock, is just going to naturally hit that stop just because of normal, activity, just because of the normal swings that are just kind of average. So you want your stop to be triggered not because of market noise, but because of something more significant. So the way that you can systematize that across different stocks with different volatilities is use average true range as your main input. That means if the stock is naturally more volatile, the stop is going to be naturally wider. And if the stock is naturally lower volatility, the stop is going to come in because you don't need as much of a percent move to trigger that stop. And so the most so I would say that would be my second one, would be the chandelier exit system. There's a whole methodology and on stock charts. If you go to what's called Chart School, which is up here, and search for an article on the chandelier exit system, they have great articles that explain the methodology. And I don't want to get into it, but overall, I found it to be a really helpful thing, especially when I have something that's been working for a while, and I'm like, I just don't want to lose too much of this paper profit that looks so amazing. Chandelier exit system is a great go-to. My third one is super dead simple, which is like an 8 to 10% stop. If for some reason I'm a bonehead and I ignore the chandelier exit system and I ignore moving average breaks and I start getting into some behavioral quagmire of justifying the losing position, the stock's down 8 to 10%, whatever it is that I set, and then I just sell it no matter what, no questions asked. Those are the three things that I generally use, and I would encourage you to start with a basic percent stop. If you have no stop in mind, start with a basic percentage stop, like 7-8% is usually a good one to start with, and just sell if it hits it. It's not going to be perfect. You're going to miss out on things, but you will avoid almost all climactic losses because you'll keep your losses small. That's a great starting point. Once you get a little better at it, I would say incorporate some of these more nuanced tools. And the best investors, traders I've worked with usually get to something involving average true range. That's a really smart way of thinking about that volatility. All right, we'll continue on here with three more questions before we do so. Quick shout out to one of my good friends at Seeking Alpha. Thanks for being long-term supporters of Market Misbehavior. They're doing a special on Alpha Picks. They were offering my viewers 10% off Alpha Picks. That's basically where they use their quant model and their quantitative team hand selects 2 stocks every month to dig into a little deeper. If you want to learn more about using a quantitative methodology, which is like scans on steroids, right? Really looking at the characteristics of good stocks and then looking for companies and stocks that demonstrate those factors today. Alpha Picks is a great way to learn more and also get some great ideas along the way. Marketmisbehavior.com/Alpha Picks is the link to check out. And thanks for checking out their work. All right, next one. A lot of people use multiple timeframes for analysis. How do you go about your process when combining 2 different timeframes and also 2 sets of different moving averages? That's a really good question, right? So if again, I don't jump around timeframes a ton on my show only because we have limited time. So I usually only have 1 chart per stock, then I'm moving on to the next one. If I'm working at an investment firm and I'm asked to give a technical, argument for or against a particular stock, I'm probably looking at daily, weekly, maybe monthly charts, maybe an hourly chart, kind of painting the overall picture of here's what's happening, here's the long-term trend, here's the short-term movements, here's how they're all related, here's what I think we need to do with the stock. You really want to think in terms of multiple timeframes. I don't mean to sit on one stock the whole time. So let's move it around a little bit. Here's Eli Lilly, which nice bullish momentum divergence, by the way, and finishing the week above the 200-day, then a nice follow-through day Friday. I think that's pretty good chart, starting to look a little bit better here. So multiple timeframes, right? The daily chart timeframe is where I often start. But then I immediately go to the weekly, and you can see on stock charts, I've got these little quick buttons. They call them quick. I forget what they call them. Quick buttons, we'll call them. Here's the daily chart, my weekly chart, and my monthly chart. And I have those like on speed dial over here. So I can quickly look at like a 7-year weekly chart, because the daily chart basically shows me Eli Lilly, coming down here. And this is after a choppy first half to the year, a nice rally in Q4 of last year. But then look at the difference between Q4 and Q1, and now this nice bounce higher. But if I look at the weekly chart, I can see that was just this period I was looking at. That's coming after, a multi-year uptrend. So now it feels like this is just a big kind of sideways phase after that huge uptrend, kind of post-COVID, going right through the COVID era. Now on my daily chart, I have the 21-day exponential moving average. I have the 50-day simple moving average. I have the 200-day simple moving average. On my weekly charts, my default, the 40-week moving average, and the 150-week moving average. So to partly answer your question, I would say I found it helpful to kind of show the daily moving averages on the weekly chart when appropriate, right? So on the weekly chart, a 50-day moving average is going to be too noisy. That's like a 10-week moving average. It's just going to be too much. A 200-day moving average is about the same as a 40-week moving average, right? 5 trading days per week on average. So the 40-week moving average is kind of like showing the 200-day average on the weekly chart. Then I have the 150-week moving average. So on the weekly chart, I'm looking at longer term averages because I really want to think about the longer term, the secular trend here. On the daily chart, I'm looking more for the tactical moves. So I'm looking at the 21-day and 50-day and 200-day. So I would say the moving averages are appropriate for each time frame. I've seen people that just do like the 50 and 200 period moving averages on every chart. That's just not a very effective way because those are not the right moving averages for other time frames, I would argue. So using moving averages that are appropriate for the time frames. John Kosar of Asbury Research, I think he uses like a 63 or 65-day moving average because that represents about a quarter. So being thoughtful about what the moving averages represent in terms of the time or why they're valuable. So if you have a moving average on your chart and you're not sure why that's on there, maybe you want to adjust those or find other ideas about what you might want to include. But that's how I would do it. And then the different time frames just tell you different answers, right? Depending on if I'm swing trading or if I'm a position trade kind of account at that moment. That's why I might use one versus the other and lean into those signals one versus the other. Next question is the 3-year chart of TLT in a falling wedge pattern. Let's take a look. TLT, I'll do a weekly chart. We'll make it like 5 years. Is this a falling wedge pattern? The 3-year chart. All right, I'll actually look at the 3-year chart. So I'm not seeing anything falling wedge-like. And I'm not sure exactly what you might be. The only thing that kind of looks even remotely like a falling wedge, if you want to know what it does look like, I mean, and I wouldn't label it this way, but like this is kind of like a fall, but it's really not because it's more like a descending triangle pattern, right? A falling wedge would be like that, right? That would be like a falling wedge, right? You'd really have to mess with this one to make any of this look like a falling wedge. So the short answer is no. I don't think this is a falling wedge pattern. A falling wedge would be both of them, the lower highs and lower lows, and we're kind of coalescing toward a midpoint. I'm not seeing that on this chart. What is a pattern I would see? Like I'm not seeing a whole lot. And I mean, the chart of bonds, right? When you zoom out, I think what's so telling is that it's just been sideways, right? If you look at where we're at right now on the TLT, and you look 1, 2, 3.5 years ago in October of 2022, we're literally at about the same level. So with all the movement in the equity space and in other commodity space and other markets, bonds have literally been flat. These are treasury bonds, the TLT, right? But I mean, the bond market has been very stable over the last couple of years. So you haven't gained much owning bonds during this period. You haven't lost much owning bonds during that period. And maybe bonds generally are kind of like slow on a total return basis. It's kind of like slow appreciation compared to stocks, which are noisy and have much better years, but also have really painful drawdowns. Bonds are generally kind of quieter. So yeah, short answer, no, I don't see a falling wedge pattern. Whoever asked that, if you want to send me like a picture of it, drop it on my YouTube channel, take a look. All right, last question. Even with decades of charting acumen and an established process, I didn't need to include that in the question, but I love your kind of compliment in that the compliment sandwich here, so I appreciate that. Thank you. What kind of changing market conditions lead you to reshape your methodology? Yeah, so this is something, again, with my premium members, we talk a lot more about this because we're talking a little bit more about positioning and kind of how to sort of navigate through these different periods. This was really, my market trend model really was designed with this in mind. And I will tell you, my market trend model, if you're not familiar, it looks at weekly S&P data, and it's the long-term, medium-term, and short-term timeframes that, as the way I see them, that's what we're kind of looking at there. And for me, the medium-term model which is this green one in the middle, when that's bullish, I want to be focusing more on capital growth than capital preservation. When the medium-term model is bearish, I want to be focusing more on capital preservation than capital growth. So what does that mean in process, in reality, right? In practical commentaries. What that means is, like, at the end of February of 2025, market looks toppy, medium-term model turns bearish. For me, that tells me I probably don't want to be taking aggressive long positions with position. So I have, different ways of thinking, right? It's your stock picking. It's like what equities you want to own, because I always own something. But then what's your allocation, right? So we're going to be more in offense, things like stocks and crypto and, gold recently, or do I want to be more in defense, things like lower volatility, more defensive areas of the market? And when the medium term model is bearish, I'm just kind of prepared to be going more into those defensive areas. And I'm probably lightening up my equity allocation as well. I'll probably have lower exposure to equities. When the market term model turns back positive, that's when I want to start stepping on the gas again and adding more long exposure and recognizing, acknowledging the fact that the primary trend is back positive. And so I'm better off, putting bets on than taking bets off. That doesn't, so they're very, I finish every episode of the show, as I will in a moment, saying it's always a good time to own good charts. So there's not a time, if there's a great chart out there, I'm going to want to own it regardless of everything I just said. But in terms of like that broader allocation, right? Am I adding risk to the portfolio or subtracting risk? The medium-term model is my main way of defining that. And when the model's positive, which it has been for the last 3 weeks, I'm adding risk to the portfolio. Is that any promise that the market's not going to turn lower on Monday? No. Do I know what's going to happen in the market on Monday? I don't. Am I comfortable going into this weekend, given what's happening here, be generally on offense? Yeah, I'm pretty comfortable with that. Will I be absolutely prepared to switch if we get a sell-off and it causes my market trend model to turn negative? Absolutely right. So I would say that is one example of how the changing market conditions really have me changing kind of the general approach that I'm trying to put into play. Things like stops are universal. No matter what is happening in the world, I'm always going to want to use good stops to get out of trades that aren't working anymore. I'm always going to want to look for breakouts. And regardless of what the medium-term model says, if some great stock looks greater, I'm going to want to take a position in some way. But that's one of the ways that kind of changes my general way of thinking about risk in the portfolio. With that, we come to the end of this week. Hey, happy end of April. Happy beginning of May. Happy May Day. I hope you guys all have an awesome weekend. I will hope to do so as well. We will have our premium, our weekly flight plan for our market misbehavior premium members over the weekend. We will be back with our market recap show on Monday. In the meantime, have a joyful, restful weekend. And remember, it's always a good time to own good charts. Take care, folks.